Students, we know that there are various ways and means through which the performance of an enterprise can be gauged. That is, there are various tools of analyzing the performance of an enterprise. By now, we know two means, that is, common size and comparative financial statements. Let us move on to the third tool. The third tool is ratio analysis. We all know what a ratio is, but application of ratios to financial statements so as to derive meaningful results out of them is called as ratio analysis. So students, defining it in a proper manner, it is a process through which a relevant relationship between two numbers in a financial statement is established so as to assess the strengths and the weaknesses underlying the performance of an enterprise. Going by this definition, it is a process through which a relevant relationship between two numbers in a financial statement is established. That means you are actually trying to strike a relationship between two numbers which are mentioned in the financial statements so that you are able to understand them in a better manner. And what exactly is the underlying reason for establishing such kind of relationship? That is to assess the strengths and the weakness of an enterprise so as to gauge how well or how bad an enterprise has fared in a particular area that we are trying to analyze. Let us understand this by taking an example. Let us take hypothetically that Mr. Ram is carrying on a sole proprietorship business. That is, Mr. Ram has a business and we want to compare his performance for 2 years, and 2 years being 2006 and 2007. Now, if you are given just the profits, and by profits I mean just the profits, you can take it to be gross profit or net profit, whatever you want. Let's say in year 2006 the profits earned are 2 lakhs and in year 2007 the profits earned are 3 lakhs. So now students, if somebody wants or somebody actually asks you which year was better comparing the net profits or the profits. So by just looking at this figure we can say that year 2006 has been better. Why? Because the profits are higher. Obviously we are ignoring the price level changes. Now let us transform it into a ratio analysis. Let's say the figures given to us are not just the profits but sales as well. This year the sales were 10 lakhs, whereas in this year the sales were 20 lakhs. So now students, let us find out the profit margins. What I am trying to do is find out profit margin. Profit margin. First year we got a profit of 2 lakh on a sale of 10 lakh into 100, that makes it 20%. And second year we've got 3 lakh upon 20 lakh into 100, that is 15%. So now here students, we have used ratio analysis. What we have actually done is establish a relationship between profits and sales, and through this relationship we can see that in first year, that is 2006, our profit margin was 20%. That roughly translates into 20 rupees profit on every sale of rupees 100. Whereas in second year this margin has fallen down to 15%. That means either your cost has gone up or whatever the factor, you are not running on the same level of profitability. Rather you have gone down. So it is clearly evident that when we used ratio, we can say that the performance in year 2006 was much better than the performance in year 2007. So students, this is how ratio analysis helps to draw out meaningful results.